When we talk about the risk of an oil crisis, we're not really talking about oil in isolation. We're talking about geography, power, and the fragile architecture of global dependence. And nowhere is that more visible than in the world's strategic oil routes. These are not just lines on a map, they are pressure points of the global economy where a single disruption can ripple outward with extraordinary speed. Consider the Strait of Hormuz. It's a narrow passage, almost deceptively so, yet it carries roughly a fifth of the world's oil supply. That means every day an enormous volume of energy, the lifeblood of modern economies, flows through a space that could be disrupted by a single miscalculation, a single escalation, or even the perception of instability. And perception in global markets is often just as powerful as reality. This is where the psychological dimension comes in. Markets don't wait for events to fully unfold. They react to signals, to risks, to uncertainty. The mere suggestion that a critical route like Hormuz could be threatened is enough to trigger price volatility. Traders begin to price in fear. Governments begin to consider contingencies. Companies start to hedge. And suddenly, the system is no longer operating on stability. It's operating on anticipation of disruption. What makes these choke points so uniquely dangerous is not just their physical vulnerability, but their symbolic weight. They represent concentration of resources, of transit, of dependency. In a globalized world that prides itself on interconnectedness, we've also created bottlenecks. And those bottlenecks are inherently fragile. Now, step back for a moment and think about what this means in human terms. Every gallon of fuel that moves through these routes eventually translates into something tangible: the cost of transporting food, the price of a plane ticket, the energy that powers hospitals, factories, entire cities. So when we talk about a disruption in a place like Hormuz, we're not talking about an abstract geopolitical issue. We're talking about something that quietly reaches into everyday life, often in ways people don't immediately recognize. This is where the analysis often gets too technical and misses the deeper point. The real issue isn't just that supply might be interrupted. It's that the system itself is built on a kind of silent assumption that these routes will remain open, that geopolitical tensions will remain contained, that rational actors will avoid escalation. And history has shown us repeatedly that these assumptions can break down. Think about how quickly stability can unravel when multiple actors, each with their own interests and perceptions, operate in the same confined space. A naval incident, a misinterpreted signal, an act meant as deterrence but perceived as aggression. These are not hypothetical scenarios. They are the kinds of moments that have in the past brought the global system to the edge. What Ian Bremmer often emphasizes is the concept of a G0 world, a world where no single power is both willing and able to stabilize the global system. In that kind of environment, strategic routes become even more vulnerable because there is no clear guarantor of security. Responsibility is diffused, and with diffusion comes uncertainty. And uncertainty is the enemy of stability. So what you begin to see is a kind of feedback loop. Rising tensions increase the perceived risk to these routes. That perceived risk drives market reactions. Those reactions create economic pressure, and that pressure in turn can influence political decisions, sometimes pushing leaders toward actions that escalate rather than de-escalate the situation. It's a system that amplifies itself. But there's also a philosophical layer to this. For decades, globalization has been built on the idea that interdependence would reduce conflict, that countries reliant on each other for trade and energy would have strong incentives to maintain peace. And to some extent, that has been true. But what we're seeing now is the other side of that equation. Interdependence also creates shared vulnerabilities. When a single route becomes essential to many, it also becomes a point of collective risk. And that brings us to a critical question, not just for policymakers, but for all of us as participants in this global system. How resilient is the world we've built? How prepared are we for the moments when these assumptions of stability, of open routes, of predictable behavior are suddenly challenged? Because the reality is resilience is not just about having Zappa's supply or alternative routes. It's about recognizing the fragility embedded in the system and making conscious choices to address it before a crisis forces those choices upon us. And right now, the warning signs are there. The tensions are visible, the risks are being calculated, recalculated, and quietly priced into the system. The question is whether we're paying attention, because in a world where so much depends on so little, where a narrow stretch of water can influence the fate of entire economies, the real danger isn't just disruption, it's complacency. If the first phase of a potential oil crisis begins with geography, with the vulnerability of strategic routes, the second phase is where the consequences become unavoidable, the moment when supply shocks translate into price surges. And And this is where the issue moves from being a geopolitical concern to an economic reality that touches nearly every individual, often faster than people expect. Oil markets operate on a delicate balance between supply and demand, but more importantly, they operate on expectations. When a conflict threatens production or transport, the actual disruption doesn't need to happen immediately for prices to rise. So, the anticipation alone is enough. Traders, governments, and corporations begin adjusting in real time, trying to get ahead of what they believe is coming. And in doing so, they often accelerate the very volatility they're trying to avoid. This is one of the paradoxes of modern markets. They are designed to be responsive, but that responsiveness can amplify fear. A rumor of escalation, a report of military movement, even a shift in diplomatic tone. These signals ripple through trading floors and algorithmic systems within seconds. Prices move not just on facts, but on interpretations of risk. And once prices begin to climb, the effects are not linear, they're compounding. Higher oil prices don't just mean more expensive fuel at the pump. They increase the cost of transportation across the entire global supply chain. Ships, trucks, planes, every link becomes more expensive to operate. And those costs don't stay contained within the energy sector. They spread outward, embedding themselves in the price of goods, in food production, and manufacturing. Inflation, in this context, is not an isolated economic metric. It's a lived experience. What's important to understand is how quickly this shift can occur. In a stable environment, markets tend to move gradually, allowing systems and individuals to adapt. But in a crisis, movement becomes abrupt. Prices spike, sometimes dramatically, and adaptation becomes much more difficult. Governments are forced into reactive policies. Central banks face pressure to respond. Businesses struggle to maintain margins. And individuals, especially those already operating at the edge of financial stability, feel the impact almost immediately. This is where the psychological dimension deepens. Rising prices don't just change economic behavior, they change perception. People begin to feel uncertainty in a more personal way. Confidence erodes. Spending patterns shift, and that shift, multiplied across millions of individuals, feeds back into the broader economy, slowing growth and increasing instability. So, Ian Bremmer often frames global crises through the lens of interconnected systems, and this is a clear example of that principle in action. So, a disruption in one part of the world doesn't remain isolated. It cascades through financial systems, supply chains, and ultimately into households. And because these systems are so tightly linked, the speed of that cascade is faster than it has ever been before. There's also an asymmetry in how these price shocks are experienced. Wealthier nations, while affected, often have buffers, strategic reserves, diversified energy sources, stronger currencies. Developing countries, on the other hand, face a much harsher reality. For them, rising oil prices can mean immediate fiscal strain, currency depreciation, and in some cases, social unrest. Energy is not just an economic input, it's a foundation of stability. So, what begins as a market reaction can evolve into a broader systemic challenge, one that tests the resilience of entire societies. And yet, there's a deeper philosophical layer beneath all of this. For decades, the global economy has operated under the assumption that efficiency is the highest priority. Supply chains have been optimized for cost, not for resilience. Energy systems have been built around predictability, not volatility. And in doing so, we've created a structure that performs exceptionally well under stable conditions, but becomes highly sensitive when those conditions change. A supply shock exposes that sensitivity. It forces us to confront a fundamental question. Have we prioritized efficiency at the expense of stability? Because in a world where geopolitical risks are increasing, that trade-off becomes more consequential. The very systems designed to maximize growth can, under stress, amplify disruption. And this is where leadership, both political and economic, faces a critical test. Do we continue to react to crises as they emerge, or do we begin to rethink the underlying assumptions of the system itself? Do we build in redundancy, diversify energy sources, invest in resilience, or do we wait for the next shock, hoping it will be manageable? Because hope, in this context, is not a strategy. What we're seeing is not just the possibility of higher oil prices. It's the exposure of a deeper vulnerability, a system that is highly interconnected, highly efficient, and therefore highly sensitive to disruption. And once that sensitivity is triggered, the effects move quickly, often outpacing the ability of institutions to respond. So the issue is not whether prices can rise. They can and they will under the right conditions. The issue is how prepared we are for the consequences of that rise and whether we're willing to address the structural weaknesses it reveals. Because in the end, a supply shock is not just a moment of crisis. It's a mirror reflecting the true resilience of the world we've built. If the first layer of this crisis is about geography and the second is about price, then the third is where the impact becomes truly systemic. This is where an oil shock stops being an energy issue and becomes an economic force that reshapes entire societies. Because oil is not just another commodity, it is embedded in almost every dimension of modern life, right? And when its price rises sharply, the effects don't stay contained within energy markets. They ripple outward quietly at first and then all at once. Think about how the global economy actually functions. Every product you buy, food, clothing, electronics, depends on energy at some stage of its journey. Oil powers the transport systems that move goods across continents. It fuels the machinery that produces them. It underpins agriculture through fertilizers, irrigation, and logistics. So when oil becomes more expensive, the cost doesn't just rise at the pump, it rises everywhere. So this is where the ripple effect begins. Higher fuel costs increase transportation expenses. That increase gets passed on through supply chains, raising the price of raw materials, manufactured goods, and ultimately consumer products. Inflation spreads not because of a single failure, but because of a chain reaction, each link responding rationally to the pressures placed upon it. And what makes this particularly challenging is that these pressures often arrive simultaneously. Businesses face higher costs while consumers face reduced purchasing power. Governments face rising public expectations while also dealing with constrained fiscal space. Central banks are forced into difficult decisions, balancing inflation control with economic growth. Every actor in the system is under pressure at the same time, which limits the effectiveness of traditional policy responses. Now, step back and consider the psychological dimension of this. Inflation is not just an economic phenomenon, it's a signal that stability is eroding. When people see prices rising consistently, it changes how they think about the future. Confidence declines. Expectations shift. Households begin to cut back on spending, not necessarily because they are already in crisis, but because they anticipate one, and that anticipation itself becomes self-reinforcing. This is where perception and reality begin to merge. If people expect prices to continue rising, they adjust their behavior accordingly, buying sooner, saving less, demanding higher wages, and businesses in turn raise prices to protect their margins. This creates a feedback loop that can accelerate inflation beyond the initial shock. And once that loop gains momentum, it becomes much harder to control. This dynamic is especially dangerous for developing economies. Unlike wealthier nations, they often lack the financial buffers and policy tools needed to absorb sudden shocks. Their currencies may weaken under pressure, making imports more expensive. Their governments may struggle to subsidize energy or essential goods. And in some cases, the strain can lead to broader social consequences, protests, instability, and political pressure. This is where an oil crisis transitions from an economic issue into a societal one. Because when energy prices rise, it's not just about abstract indicators like GDP or inflation rates. It's about whether families can afford basic necessities. It's about whether transportation remains accessible, whether food remains affordable, whether businesses can continue operating. These are not distant concerns. They are immediate and they are deeply human. What Ian Bremmer often points out is that in an interconnected world, risk doesn't stay contained. A shock in one part of the system propagates through others, often in ways that are not immediately visible, and oil, more than almost any other commodity, sits at the center of that system. It connects energy markets to food systems, financial markets to political stability. So when oil prices rise sharply due to geopolitical tensions, the consequences are not just economic, they are structural. They expose weaknesses in how the global system is built. For decades, globalization has delivered extraordinary gains, lower costs, greater efficiency, expanded access. But those gains have come with a trade-off, increased interdependence. And interdependence, while powerful, also means shared vulnerability. When one major input like oil becomes unstable, the effects are not localized, they are global. This creates a difficult reality for policymakers. Do they prioritize short-term stability or long-term resilience? Do they intervene to control prices, risking distortions in the market? Or do they allow the market to adjust, risking economic hardship in the process? These are not easy choices, and there are no perfect answers. But what is clear is that the world is entering a period where shocks like this may become more frequent. And if that's the case, then resilience can no longer be an afterthought. It has to be built into the system itself. That means diversifying energy sources. It means strengthening supply chains. It means preparing economies to absorb volatility rather than just respond to it. And perhaps most importantly, it means recognizing that economic stability is not guaranteed. It has to be actively maintained. Because the true impact of an oil crisis is not measured solely in barrels or percentages, it's measured in confidence. Confidence in markets, confidence in institutions, confidence in the future. And when that confidence erodes, the consequences extend far beyond economics. They begin to reshape how people see the world and how they act within it. And that is where the real challenge lies. If supply shocks and price surges are the immediate consequences of an oil crisis, then what follows is often more subtle but far more consequential over time. This is where the global system begins to shift, not just economically, but politically. Because when energy security is threatened, countries don't just react, they reposition themselves. And in doing so, they reshape the balance of power. Energy, especially oil, has always been more than a resource. It's a form of leverage. It influences alliances, defines dependencies, and in many cases determines strategic priorities. So when a war disrupts major supply routes or production centers, the first instinct of nations is not just to stabilize prices, it's to secure access. And that instinct can lead to rapid, sometimes unexpected realignments. What emerges is a kind of geopolitical recalibration. Countries that once relied heavily on a single source of energy may begin to diversify aggressively, seeking new partners, new routes, new suppliers. Strategic relationships that were once stable can suddenly become transactional. At the same time, countries that control energy resources gain influence, not necessarily because they choose to, but because the system places them in that position. This creates a dynamic where energy and politics become deeply intertwined. Decisions about energy are no longer purely economic. They are strategic, sometimes even existential. Governments begin to view energy not just as a commodity, but as a tool of national security. And when that happens, the nature of international relations begins to change. Now consider the psychological dimension of this shift. In times of uncertainty, actors behave differently. Nations, like individuals, become more cautious, more protective, sometimes more assertive. The perception of vulnerability can lead to actions that, under normal conditions, might seem unnecessary or even counterproductive. But in a high-stakes environment, these actions are often seen as essential for survival. This is where escalation risks increase. A military move intended to secure a supply line can be perceived as a threat by another actor. A defensive measure can be interpreted as offensive. And in a system where multiple actors are making decisions simultaneously, each based on their own risk assessments, the potential for miscalculation grows. History has shown us that many conflicts don't begin with a clear intention to escalate. They begin with a series of decisions that, in isolation, seem reasonable fights. But in combination, they create momentum. What Ian Bremmer often highlights is that we are operating in a multipolar world without clear global leadership. And in such a world, coordination becomes more difficult. There is no single authority capable of enforcing stability across all regions. Instead, we have a network of powerful actors, each pursuing their own interests, each reacting to developments in real time. This lack of centralized coordination makes the system more dynamic, but also more fragile, because when energy security is threatened, countries don't wait for consensus. They act. And those actions, even when intended to stabilize, can sometimes have the opposite effect, heightening tensions, increasing mistrust, and contributing to a cycle of reaction and counter-reaction. There's also a broader philosophical question here about dependency. For decades, the global system has been built on the assumption that interdependence reduces conflict, that when countries rely on each other, they have a vested interest in maintaining stability. And while that is true in many cases, it's also incomplete. Because interdependence doesn't just create cooperation, it creates leverage. When one country depends heavily on another for energy, that dependency can be used as a tool of influence. And in times of crisis, that influence becomes more visible, more deliberate, and sometimes more contested. This doesn't always lead to conflict, but it does change the nature of relationships. Trust becomes more conditional. Agreements become more strategic, and long-term partnerships are reevaluated through the lens of resilience. This is how global power begins to shift, not through sudden dramatic changes, but through a series of incremental adjustments. And those adjustments accumulate. Over time, we may see the emergence of new alliances, new energy corridors, new centers of influence. Countries that were once peripheral may become more central. Those that were dominant may find their position challenged, not necessarily because they've weakened, but because the system around them has evolved. This is not a collapse, it's a transformation. But transformation, especially in a system as complex as the global energy order, is rarely smooth. It involves friction, it involves uncertainty, and it requires adaptation from all participants. So the question becomes, how do we navigate this moment? Do we double down on existing structures, hoping they will hold under pressure? Or do we begin to rethink the foundations, diversifying energy sources, strengthening alliances, and building systems that are more resilient to disruption? Because the reality is the current moment is not just a challenge, it's an inflection point. And how countries respond to that inflection point will shape not just the outcome of this particular crisis, but the broader trajectory of global stability in the years to come. Energy has always been at the heart of geopolitics. But in a world defined by uncertainty, it becomes even more central. It influences decisions, shapes alliances, and ultimately determines the balance between cooperation and conflict. And in that balance lies the future of global order. Because when energy becomes uncertain, power becomes fluid. And when power becomes fluid, everything is subject to change.